Welcome back. You're watching Stockwatch with me, Zinati Guma, and joining me to unpack your stock-related questions tonight are Mutooni from Sanlam Investments and David Shapiro from Sasfin Securities. Please be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Don't worry, David, you've got us confused, thinking that it's Wednesday. It is not Wednesday, it is Tuesday. But let's start off with you. The last day of trading. Everything is in the red. What have you made of what has gotten us here? This negative sentiment to end of the month, David?
Well, it's only on the mining markets. The other three markets, financials, industrials, and property, were all positive. So mining companies came down, particularly gold. If you look at the gold price, below 2,300. And we always warn people who go into gold, as soon as you start to think it's going to 25 and so on, it comes back and slaps you in the face.
Yeah.
So it's just true to form, under pressure, and it's taken down all the mining stocks. So I think that was, that's what took us down. But I mean, apart from that, there were more gainers than losers.
Yeah, it's actually quite interesting that you zoom in on gold, because Harmony Gold actually came out with a good trading statement, operational update, and it looked like all the metrics were going right. Cost down, production up, even the price of gold up, also revising up their guidance, but that share price sunk more than 4%. Roy, I don't know, what do you do as an investor of Harmony Gold and all the gold miners when those stocks are so beholden to the gold price?
That's $1 million question. I mean, if you look at Harmony from an operating perspective, those guys have done a phenomenal job. These were marginal mines historically, loss-making, high cost and all that. You look at their all-in sustaining costs, it's competitive with absolutely anyone. You look at the profile of production that's coming, it's as good as anyone. But the thing is, you get into this one for geared exposure to the gold price, like David said. Now, you've got a marginally stronger rand and a marginally weaker gold price. That's going to hammer you. So if you're in it as a speculator that you want to get this geared exposure, you have to be able to write down days such as these. And I mean, with gold stocks, 10-20% in a day or a week is not unheard of. You have to be prepared for that, right, to be honest. But from an operating perspective, I mean, I think the stock management is doing as good as they can, and it's coming through in the numbers.
All right. David, I think this one will excite you a little bit more. Apple. The share price of this stock has declined over the last 3 months. Is this just a correction or something to be concerned about? And if so, do you bank the profit? Apple.
Yeah, it's the one stock that I've never been able to get a hold of, largely because it's difficult to really get your head around it. It's on instrument sales. They're having a huge issues in China, competitive issues. And there again, how do you keep people satisfied? How do you get them to keep changing their phone or to be modernizing their phone? And the other thing, look, they've got a lot of other areas in which they capture money, but it's the one I kind of stay away from, simply because I think you get to a point where, do you really have to change your phone every year? It's every 3-4 years. Eventually, yes, you've got to go through that. And once you're an Apple person, you're always there. But I don't know. I find it a very difficult one to look. They're enormously wealthy, got huge amounts of cash, etc. But I don't think they can compete with a lot of others that are AI kind of focused. I'll give Roy his say and then come in again and just continue the conversation.
Yeah, I mean, it's interesting getting that note of caution from you, David. And I mean, when was it? Just last month we were reporting, or earlier in the month, that Samsung actually surpassed Apple as the, I think in terms of volumes. So Roy, I mean, do the current financial metrics kind of lead to maybe a peak in sentiment where maybe the future may not look so great?
So I see David's difficulty with this because they produce what is effectively a highly commoditized product, which is a cell phone, and everyone makes cell phones. All the Chinese and the Koreans and everyone makes cell phones, but they've been able to sell them at a premium because of this brand equity and innovation and stuff. But the reality is they haven't shown much innovation in the past few years. I think ever since, and I lose count of which iPhone it was when they added one camera or something like that, they haven't really advanced far. And in a place like China now where they're struggling with sales, I think I think they get into that peak where people want to see some more of the excitement that came from when Jobs was there, when they were producing new things. I mean, it's been the phone, the iPad is the iPad, the iMac is the iMac. So why should it trade at a significant premium? It's a big business that has lots of cash in the balance sheet in a big brand, but beyond that, it's very hard to tell. And I think that's probably what you're seeing right now. People are looking through all of the jazz and trying to get where's the earnings going, and all you see there is a really commoditized business, to be honest.
All right.
They've got an AI policy that they want to introduce, but I'm trying to work out what that's going to mean. If you're now going to find an AI phone, okay, or how am I going to use it?
Because aren't they partnering with Google on that now?
Well, sure, but I mean, it's how you're going to use it to your advantage, I don't know. I don't know whether you need a special phone for that. So we'll see. Look, the results are out, I think, in the next day or two. We'll get some kind of feeling for where they are. But it's just, it's a massive business. It's number 2, I think, after Microsoft. So you can't just dismiss it. But, for choice, I'd rather have Microsoft and Google and NVIDIA and all the others. If I have to drop one of the Magnificent Seven, I think it'll be Apple. Although I don't include Tesla, so so that's too far.
All right. Well, to the viewer, I guess we'll get more information on that when those results do come out this week. Let's go on to Capitec. What's the panel's view on Capitec? Do you hold it in your funds? Roy?
So Capitec has this thing, it's always looked expensive. You look at it on a price to book basis, it's at like 6s and 7s, maybe about 5-ish now. When you compare it to the other big banks, the big banks trade at 1.5, maybe First Round is at 1.8 price to book. So it looks incredibly expensive. But if you adjust for the cash that they hold because of the excess capital buffer, maybe it's more reasonable. The thing about it is that I think they play in a different market and they seem to have gotten their market incredibly well. They're delivering from an earnings perspective. They're slowly inching into the business market where they could start eating other people's lunch. And they've maintained that innovation edge and that hunger. So to be honest, it will always look expensive, that's for sure. But earnings keeps coming through, even through difficult times. I mean, you have to be cautious because of its exposure to the lower end. But I think if there's a management team you can count on to understand its base customer and understand where its customer is going, it would be these guys.
David, I know that there was a point when as much as, you were optimistic about the numbers that the banks were churning out, but you were worried about future growth considering the backdrop of the economy that we are in. Are you still in the same space? And what would you say about Capitec, particularly as Roy mentions, its exposure to the market that it is exposed to?
No, it's a brilliant bank. And I'm not one who's persuaded by metrics because I don't understand it. I don't understand price to book. I don't understand PE ratios. I don't understand any of that. So I just like the business. And it's never guided me. I know what they are, but it's never been a guidance because this is a very innovative business. Its customers love it. And it's very hard to take customers away. And why I don't like the big banks is that first of all, they don't lend money. you can't walk into Standard Bank or First Rand and get a loan, no matter what business you have. There are barriers there that it's almost impossible to penetrate. That's why they make money. But, and it's why the country never grows, because the banks won't lend you money to try and make you grow. But but Capitec I've always liked them, and they're not dragged down by legacy issues. And, for that, and they continue to innovate. So I see they're trading at almost their all-time high, which wasn't too long ago. I think they reached a high a couple of years ago, fell, and now back there again. But very good business. And I think that I enjoy companies like this that keep growing, keep innovating, and whose customers love them.
Yeah, it's really quite interesting because we've basically seen the growth of Capitec in real time, now being a diversified financial services group from a retail bank.
I think, I'm looking carefully, and I've discussed this before at Old Mutual Bank, because Old Mutual's got a client list that must go into multi-millions. And I'm saying, hold on a sec. They know a lot of people that they can phone and knock on and go to, more so than any of the new banks.
Yeah.
I think they're in a very favorable position at the bottom end of that market, lower income groups, to attack. And I would imagine their attack would be against someone like Capitec, or the market that Capitec wants. So I watch that space with interest, because I don't think it was a dumb move. I think it was quite a smart move.
Yeah. Well, quite interesting actually on Old Mutual, because I did have someone on, an analyst, and he was actually saying that Old Mutual did have banking exposure with Nedbank, and they said that they want to concentrate on their core offering, but now they seem to be going back. Is that not a concern, David?
No, different market. Ask Roy. He's at Sanlam. Ask him how many customers they got. Multi-million. He doesn't phone them all, but he can.
Yeah.
Sanlam, you don't have to worry. Me, I have to go knock on doors and try to get customers. But Sanlam, they just come in. They knock on your door. So he's in a very privileged position.
Yeah. I mean, that's the thing.
And I know it's just, but it's true.
Yeah.
And I think Mutual are in that kind of situation as well. They've got hordes of salespeople out there, hordes of them.
Yeah.
You go to every city in this, every little town, Dorp in South Africa, there's Sanlam.
Yeah. All right. Well, Gerrie said he's not worried about Old Mutual Bank, but we'll see when the bank actually does come online. All right, gents, we are looking into more questions. So I actually have to go find it. I don't know. I never know if you say Montauk. Anyway.
It's an Indian name. I mean, an American Indian name.
It's Montauk. Oh, okay. All right. Are there good fundamentals on Montauk? Volumes traded are very thin. A good buy or a goodbye? David?
Well, the chart says goodbye. No, bye.
Yeah, investors have been saying goodbye.
It's heading in one direction. I can't say I follow it very closely. I know HCI had some kind of interest in it, but I don't know what's sunk them, because I think a couple of years ago they were a very hot stock that shot up, but subsequent to that they've just fallen away.
Yeah, I've
got no real feel for it. It's not one I follow closely.
Yeah, and they don't have SA operations, right? It's just in the US. And I remember when the price shot up was, I think, 2022, after the invasion of Ukraine by Russia. Roy, do you have any views on Montauk Renewables?
To be honest, no. I think David covers even more than I knew. So.
Yeah.
But if you were there quickly, you could get a chart and say, just, it's one of these from the top left to the bottom right, But it doesn't look like it's going to turn out either.
And yeah, I know that share price just keeps on slumping there, even today down 6%. Roy, I just want to stick with you. The viewer says, I am very skewed to growth stocks in the USA. Have been reading that shift to developing markets, Europe, India, China, and ETF in this regard is my play. Maybe Baidu, JD, Process as China view. is it a good idea to spread half my portfolio to this more global spread for a long-term investment?
That's actually quite a good question. It's very comprehensive. I think maybe if I gave you a framework to think about it. So as it stands right now, that US market is more expensive than all these others. So intuitively, you would say you want to start rotating. But before you do that, just remember one of the reasons is the US is where all the capital is going. The US is the only economy that's really growing, and it's maintained its growth profile. And even at these high levels of interest rates, they are still growing. So earnings are actually coming through in line with GDP growth as well. So it's not yet time to leave. There's definitely some solid earnings momentum, and a lot of the shares, if you're nicely selective, will provide returns. On the other side, China's underperformed massively for a long time and for a variety of reasons. And you'll find incredibly cheap companies there, but there could be a geopolitical premium or discount put onto those. So you have to be very sure what your catalyst is for that to move. But when you look at everything in totality, when the dollar is this strong, the traffic is one way, and the pain is one way. Everybody outside of the dollar feels the pain because most people are oil importers, and in a strong dollar environment, you will just keep paying more and more. And the people who benefit are, that's the Americans, the dollar-based economy. So I would say, yes, theoretically, that's the way to think, that you need to diversify. I would think that there's probably some more juice in the US if you have a nicely diversified portfolio there, but it's not a stampede out of it.
Yeah, it's a really
articulate. Nice articulate answer there.
Yeah.
Well, you give Roy the questions before. They were so well prepared.
David, do you stay? Roy says, listen, also stay where your bread is buttered, but also
I agree with him.
The valuations over there are quite cheap.
Zarate, the one area that I can't get a hold. I like Europe and the companies I like in Europe. I'm not ready for China again, even though it's recovered quite significantly. And there's been a little bit of a mini boom, I think, coming from a very low level. The one I can't understand is India. You know, the index is strong. It's going to be the third biggest economy soon, but it's very fragmented and very difficult to understand, to buy. Well, which company do we buy? The index has done well, but it's made up of lots of little businesses, etc. But we can't ignore that economy. In other words, we can't brush it aside. There is growth there, but someone help me. Where does one go? What kind of area would you buy? But until you can really put your finger on something, or your finger on the pulse there, I just I watch it from a distance and say, okay, hopefully they keep buying goods, from the companies I like Scotch, like whiskey and things like that. Yeah.
Well, something I think I remember you don't watch from a distance, David, is a capital appreciation. Your view on it?
Disappointing results recently. Again, it's a small cap, but I haven't. Again, I look at the results when they come through, and being an old man, the next day I forget what I read. So I'm in that situation. But I know as well. It's a kind of business that would probably thrive when things really pick up because of the kind of service that they. It's aligned to the retail business, and they'll do more trade as people buy more. But I got to look at the chart while we're talking if I can.
Yeah.
But I know that the last set of results were pretty disappointing, and there was quite a bit of pressure on the price. Yeah, they're just going sideways. Haven't really made any deep progress. They fell, but just seem to be tracking sideways.
Roy, any insights on capital appreciation? Is this one that is on your radar?
David's absolutely right. You need a pickup in that SMME space, in people taking some of the terminals, and they'll only take that if there's increased economic activity that allows people to expand the activities that they're doing in the retail space. They started off well. They've got some very innovative products. They're in that fintech space, but it's tough when the economy is not growing. It really is. You invest a lot, you employ a lot of people, and you're depending on subscriptions that also depend on the number of tills and point of sale systems out there. And that's not going to grow unless you see increased activity. So I think that's the reason why it's probably going sideways now. You can't depend on them to have an extremely generous dividend. They're small cap as well, very liquid. So yeah, all these things against them. But like David, I know the management team. Very, very astute bunch of people.
They all deal with Roy. He gets their business. I don't. But you can give them an endorsement.
Oh, very spicy. There's a question here. What investment would be the best to put in a tax-free savings account, local top 40, S&P 500, or property index fund? David?
Say that again. Which?
Best to put in a tax-free savings account, local top 40, S&P 500, or property index fund?
Now, I'm only S&P 500.
Okay. Okay.
I'm still big on the S&P 500.
Where the butter is.
That Roy said in the previous answer that he gave, you know, it's still where capital is flowing.
Yeah.
It's still where the innovation is. It's still where the big companies are, regardless. It's still going to dominate for the next decade. Yeah.
Roy, would you also apply that narrative to this as well?
So the thing about a tax-free savings account is that you can trade in it without capital gains, and it's a long-term investment. You don't get your money out, right? You keep your money in, and you go up to 500,000 and everything. So what you would like is exactly what David is saying, something that will give you capital gains over the long term. That's one. Another thought could be something that also gives you a bit of dividend income. So a high yielding thing that gives you capital for you to keep reinvesting, because that's not counted as part of your contributions. So nicely diversified, get the big gorilla in there, get some nice yielders in, and watch your money compound over time. Definitely.
All right. Kibo Energy. Do any of you look at Kibo Energy? Because there is a question on it here.
Roy could buy it with his spare change. It's a 1 cent company.
Yeah, because this is a question. I've been holding Kibo Energy for 2 years. Currently, my price of holding is 2 cents, but the market price is 1 cent. What's the outlook for that? And is it a good hold?
Not good. The reason you've been holding for 2 years, there's no buyers there. It's only sellers of 1 cent. So,
oh dear.
It's got a market cap of 45 million, I think. Even at 1 cent.
1 cent.
I don't even know what they do.
No.
Hey, it's for us. It's for us. Let's get to your stock picks. Roy, what are you picking today?
Yeah, I'll keep it nice and simple. I still like Bidcorp. I think even especially at current prices, this is a business that is nicely diversified globally, feeds into the move from retail to out-of-home eating. For as long as developed market economies are growing their people's income and inflation is not going backwards, inflation is increasing, this is a business that's going to do well. The management there don't do spectacular things. They don't try making big acquisitions. They make small ones. They know where their market is. They execute extremely brilliantly, and through the cycle, they'll earn returns ahead of cost of capital.
All right. David, what are you choosing today?
I'm going for Eli Lilly. I've been going on about Eli Lilly and Novo Nordisk for some time now. But I think what comes through in the results that they published today, just what the outlook for obesity and diabetic drugs are, especially Zepbound, which is theirs, which is Eli Lilly's. Novo Nordisk, we know, is Wegovy and
Ozempic.
Yeah, so when you read the results today, you'll just see what kind of demand they're expecting, what kind of sales outlook. This is a very big theme, probably the most attractive in the pharmaceutical area. And this is not play. And it's not it's not a fashionable drug. These are very serious drugs. And Novo Nordisk can't keep up with demand. So the share was up, Eli Lilly up 5% today, 5 or 6% today. I think this is going to continue to perform. So it's still the one I like.
All right. Well, thanks so much, gents, for your time, analysis, and laughs. Do enjoy your holiday tomorrow. That is all for tonight's Stock Watch. Thanks to our guests, Roy Mutooni from Sanlam Investments and David Shapiro from Sasfin Securities. Up next, The Close. Stay with us.